With year-over-year CPI growth in the US clocking in November at 6.8%, inflation is a huge concern for all investors right now, real estate investors included. And with annual CPI increases topping 5% every single month since May of this year, inflation looks to be a lot more than just transitory at this point. And with that, investors are buckling down for the long term, and bracing for these types of numbers that could last well into 2022 or even longer. And while many people refer to real estate as an inflation hedge, these people also tend to lump all real estate together in that statement. But in my experience, all real estate investment strategies are not created equal when it comes to investing in an inflationary environment. So to help you plan your next moves if these inflation numbers do continue for the foreseeable future, and help you make sure that rising consumer prices end up being a tailwind to your portfolio rather than a hindrance, in this video, let's walk through 3 investing strategies that real estate investors use to benefit from inflation and why each really matters. So the first point on this list is especially relevant in today's market, specifically because of how cheap money is right now, and that is maximizing leverage on your deals and locking in long-term fixed rate financing. Inflation makes it more expensive to buy goods, services, and even investment assets. However, outstanding loan balances are not affected by CPI increases, making borrowers some of the biggest beneficiaries in an inflationary environment. And from a real estate perspective, this can make a huge impact on not only value increases, but also cash flow yields, especially on fixed rate loans with payments that are going to stay constant throughout the entire loan term. For example, if we assume we buy a property for $10 million at a 4.5% cap rate, and we finance that property at a 70% LTV ratio at 3.5% interest, assuming those loan payments are interest only, our cash on cash yield in the first year of our hold period would be 6.8%. However, if our NOI jumps by 10% the following year due to inflationary pressures that drive up rents, that $245,000 loan payment is still going to stay the same, but our NOI will actually increase to $495,000 this year, resulting in our cash on cash return in the second year of our hold period jumping up to 8.3%. And if this continues for another year, that loan payment will still come in at $245,000 for the year, but with the NOI of the property now at over $544,000, that cash on cash return has now jumped up to 10%, and the actual cash flow in our pocket has now increased by almost $95,000 from the initial $205,000 yield, which represents a 46% increase by just the third year of ownership. And increases in cash flow yields aren't the only benefits of adding leverage to your deals, since significant value increases in the market can also have a huge effect on equity returns for borrowers, and the more debt you have, the greater that magnification is going to be. And the way the math works here is actually pretty simple, and you can calculate the change in equity value for an investor by taking the value percentage change of the property itself and then dividing that by 1 minus the LTV ratio. So for example, on a property with a 50% LTV ratio, a 10% increase in property value would lead to a 20% increase in equity value, since 10% divided by 50% equals 20%. And if we saw that same 10% value increase at a 60% LTV ratio, this would lead to a 25% increase in equity value, since 10% divided by 40% equals 25%. And as the LTV continues to increase, equity values start to see even bigger gains, with a 70% LTV ratio turning a 10% value increase into a 33% equity increase, and an 80% LTV ratio turning that same 10% value jump into a 50% equity increase for the investor on the deal. Now, debt can be a great way to combat inflation, but if you don't want to be over leveraged, or you want to add another layer of protection to your investments, the second strategy on this list to protect against rising consumer prices is to only invest in properties with consistent short-term base rent increases at fair market value. In inflationary environments, assets like single-family rental homes, multifamily housing, mobile home parks, and self-storage properties can all be excellent inflation hedges with leases that tend to only be about 6 to 18 months in length, meaning that rents at these properties are constantly being reset to current market values. And on the other hand, properties with long-term leases tend to really struggle during inflationary periods, with property types like retail, office, and industrial, which often operate with lease terms of 5 to 10 years or more, often falling behind market rates during these times, with rent escalations in these leases often being fixed at 2.5% to 3% per year or 10 to 15% increases every 5 years. However, with that said, just because a property has long-term commercial leases doesn't necessarily mean that this is a property that you want to avoid altogether, since instead of fixed rent bumps, some commercial leases will actually call for base rent values to be adjusted annually based directly on changes to the consumer price index, meaning that rises in rents at the property will specifically be tied to inflation each year. And if this is the case, a 6.8% increase in the cost of goods and services in a given year can still be passed on directly to tenants, which ends up serving the same purpose as short-term leases to protect the investor on the deal. And unlike residential leases, commercial leases can also have a huge advantage during inflationary times, with many retail, office, and industrial leases, including operating expense reimbursement structures, essentially passing on the operating expense load and any increases as a result of inflation back onto the tenant. Retail properties specifically also sometimes include leases with a percentage rent clause, which essentially entitles a landlord to a percentage of tenant sales, and even if increases in base rent lag behind CPI increases, increasing consumer prices will generally result in higher sales figures for retail tenants, increasing the percentage rent owed to that property owner. Now, to round this list out, the third and final recommendation for real estate investors to protect against inflation has to do with the age and condition of the real estate you're investing in, and that is to buy newer properties or properties with very little need for significant renovations. As the consumer price index increases, the cost of labor and materials required for new construction also increases, which tends to lead to fewer development deals penciling out and generally a reduction in new supply. And this means that by buying a newer property, you're very likely buying at a discount to replacement cost or for a price that is less than it would cost you to build that same property in the same location, but you're also presumably buying an asset with very few capital requirements and upcoming renovation needs over the next few years. And for the same reason that inflation causes issues for ground-up developers, major value-add projects with a significant renovation component also becomes significantly more expensive, with big spikes in CPI, causing some investors to have to pause or even cancel completely major renovation plans after seeing a 20 to 30% bump in construction costs over their initial budgeted figures. And if the supply pipeline slows and renovations on existing properties slow as well, buying new product will also mean that you'll likely have the nicest property on the market for the foreseeable future, and you can charge market-leading rents as a result. Ultimately, real estate can be a great inflation hedge, but the strategies you use when investing during these times are really important and can make or break your deal. And if you're looking to invest in the new year and you want to learn more about how to analyze real estate deals, or you're just looking for some pre-built templates to help you value properties you're taking a look at, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, our entire library of pre-built acquisition, development, and waterfall models for multifamily, office, retail, and industrial deals, and you'll also get access to private one-on-one email-based career coaching if you're looking to break into the industry and want some additional guidance and feedback along the way. And if you like this video and want to see more content on this channel on economic factors affecting the real estate industry, make sure to hit the like button to let me know, and let me know in the comments where you think inflation is headed in 2022 and beyond. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.